Hi guys, welcome back to the Pie Podcast. I am your host Irene. As usual, share, like, subscribe, and all that jazz. Today I'm going to be talking about a topic that I think is really interesting, and I hope you guys enjoy it as much as I do. I'm going to be mixing a couple of different topics here to make it into one episode that really gives us context into what our investments do. So I'm going to touch on black tax slash what I call cultural tax, and I will explain why. I'm going to talk about pension funds. I'm going to talk about the economy of investing. So I recently saw a post on the internet that was sort of describing why certain people don't invest in pension funds. And I started my career in investing in pensions. And so that just had my back up straight away. I just could not handle it. I almost lost the plot. And I thought, okay, I think I need to speak on this to perhaps give a different perspective and let people have more insights. So I'm going to go straight into black tax. So I choose for this episode to call it a cultural tax. Now, black tax is a term that originated from South Africa, and it's essentially a term that refers to individuals who have made it in the family, having the responsibility to support the rest of the family and the rest of the community financially. Now, it's a practice that happens across the globe. It's not specifically linked to, only Black people. It's linked to a cultural aspect of different continents around the world. I'm just going to give you some facts here because I don't want the internet coming for me because I'm not calling it black tax. I think for the purposes of this episode, because of what I'm trying to explain, I'm specifically going to refer to a cultural tax. So in 2024, the remittances from the diaspora back to the different continents around the world, this is low and middle income regions, was in the area of 685 billion, give or take. East Asia and Pacific Asia, which includes China, had $136 billion in remittances. Europe and Central Asia had $64 billion. Latin America and the Caribbean had $163 billion. Middle East and North Africa had $58 billion. South Asia was by far the hugest with $207 billion, and Sub-Saharan Africa was $56 billion. And so I hope putting these numbers out there gives some context into why I would call this a cultural tax as opposed to a black tax, because across the globe we have similarities in culture, and this is one of those things that we're very similar in. Now, for the communities living in the diaspora, I would like to use this opportunity to really encourage you to think about the amounts of money that you're remitting back to the continent. And I'd like you to think about this in relation to your personal budgets. If you don't have one, definitely get a budget together. Supporting the continent is absolutely a fantastic thing. I do not bash this culture. Actually, many of us are beneficiaries of this culture. And because of that, I would like for us to continue doing what we're doing because we are really creating significant impact on the economy. The second thing I would like to say about this is because we're also individuals who are looking to build generational wealth. I want us to challenge ourselves in the fact that if I am remitting, say, $100 back home every single month, is it possible for me to invest at least $100 for myself, for my future and my financial well-being? Because I've heard people being caught up in the trap of where you have to send money back home and eventually you don't really have anything for yourself. I think there's a space for these two aspects to really coexist together. This is something that I would like for us to begin to think about. So I'm going to move to pension funds. And the reason why I talk about pension funds is because I think pension funds are a good way to explain the economy of investing. I saw a post recently that spoke about not investing in your pensions or people opting not to invest in pensions. I'm never walking away from investing into a pension pot because I think it's the right thing to do for a couple of different reasons. One being that if you're somebody who is not disciplined with your finances, then investing into a pension pot takes away that stress of you having to, worry about meeting targets that you're struggling to achieve, being that if you were to be left with your money, then you could not responsibly invest it, or you would make choices that would lead you away from investing those finances. That's number one. Number two, because we're people who are on the financial literacy journey, it's good for us to be able to have a fund set aside for our future and our retirement, so we can actually minimize, if not eliminate, the need for cultural tax later down the line for future generations. Now, pension funds are interesting for a couple of reasons. So I'm going to talk about this from the perspective of being a Kenyan. And if you remember the story of the Adani Group, now the Adani Group was an investor that was trying to invest in the Kenyan airport, and I suppose they wanted to own it outright. Now, this came into the public awareness and it caused a lot of havoc. And I think the terms of the deals, from what I remember and what I briefly read, were indicating that no other airports could be built in the country for a certain amount of time until that investment was repaid, which was going to, above 20 years. And those terms seemed a little bit unfair. And having a private investor at that level own such a huge national asset, I think was absolutely ludicrous. And you can see why the nation was in uproar about it. And I'm absolutely glad that that deal was actually scrapped. Now, pension funds come into play here because pension funds are actually a vehicle through which we can get great economic development. Now, if you think about your investments, whether they're in pensions or outside of pensions, then you're thinking about not just growing your own generational wealth or growing your own investments or enriching yourself. I would like for us to think a little bit wider than that and think about the economic impact of what we're actually doing. And particularly for continents and regions and countries that are termed as emerging markets or developing economies. By investing in general, right, you are essentially facilitating the growth of different companies, which essentially have an impact on the economy because they're creating jobs. They are meeting the supply and demand within the economy. They're sort of feeding into the innovation ecosystem. And additionally, these companies are also paying taxes, which is a big source of revenue for any given country. Because you're an investor, you were doing all of that. Even without thinking about it, you were doing that. And as a shareholder, somebody who owns shares in a particular type of investment or a type of company, we have what you call voting rights. And voting rights are essentially, they don't tend to come with all shares, I'm just going to say that, but on average, many shares tend to have voting rights attached to them. And for that reason, you can actually influence what these companies are doing. So if we think about climate change, if we think about being, environmentally friendly and ESG, environmental social governance side of life, then impact investing, which is what we call it, is actually a style of investing that we want to consider in the types of investments that we're making. Now, I'm not one to bash companies that don't participate in ESG investing. That's not what I'm here to do. I'm just here to give you information on how you can actually use your voting rights to influence what companies are doing. So there's ethical sides around this. So if you think about investing in tobacco companies or alcohol companies, it means that you're encouraging the consumption of these type of products. And by voting or holding shares in that type of company, right, you potentially have the voting right to influence the decisions that the business makes going forward. So again, just to clarify, as an investor, you are basically holding a lot of power in your hands and you can influence decisions that companies are making. So let's think about the flooding incidences that happened in East Africa fairly recently. Now, anytime you have such a crisis, like a natural climate related crisis, then the economic loss attached to that is actually quite significant. You might find it's in the millions or even billions at times. Think about the Adani deal, where you're finding a foreign investor who wants to make unfair deals with the government, and this is closely linked to your national assets. How can a pension fund come into this and help make more national friendly deals and support the government in its initiatives? And how can you as an investor as well take part in some of these deals to ensure that you're also facilitating local economic growth. So pension funds would invest in projects such as what we call private equity, private debt, and infrastructure assets. They'll also invest on the stock market in your equities and your bonds. If you're thinking about an airport investment or investing in infrastructure assets like flood defenses, then absolutely pension funds globally are investing in these types of assets. And so you can think about if the pension economy in Kenya, for example, is very developed, you could find a series of perhaps even 5, 6, 7, 8, 9, 10 pension funds coming together as public-private partnerships working alongside the government to invest into these types of investments and then secure a steady return for the pensioners in the future. Now, why I like this type of investment is because an airport is a long-term asset. The cash flows that you're going to be getting are long-term cash flows. And if you think about perhaps, let's say you're talking about a 20-year-old or a 30-year-old who's due to retire in their 50s or 60s, that's a very long-term investment that you're going to be making. And so that style of an investment is actually very agreeable for pension funds. And actually, I like that because it also puts ownership of those assets back to investors within the economy, and it gets rid of investors who are very predatory and just want to make returns without thinking of the impact on the national resources, national assets, and the people in the local economy. Pension funds also invest in real estate and they invest in residential properties as well. So remember when you talked about investing in real estate, investing in properties, we said that you could do this through real estate investment trusts. Now, pension funds are huge participators in REITs as well. And so if they are able to invest in housing, it means that should you have incidences such as, what happened recently where there was flooding and a significant amount of people lost their homes, then you can find that pension funds can come together, invest in housing projects, and support the government in these types of infrastructure and projects across the country to be able to facilitate good quality housing for the local residents. Additionally, investing in infrastructure projects, like I said, flood defenses, pension funds can come in very heavily here and again invest in projects that are going to eliminate such losses as we have seen in the past when it comes to flooding incidences. So, as an investor, it's important for you to think about investing beyond your own personal benefits. Think about somebody who's building generational wealth. What are we preparing for the next generation that's coming that they can actually be in a position where they can benefit from the generational wealth that we're looking to build? If we don't care about the environment, if we don't care about our countries, if we don't care about the types of projects we're investing in, then really we're not leaving much for the future generation to come and enjoy anyway. So what good is it in building generational wealth and leaving it to a generation that is tackling so many problems that they actually don't even get to enjoy it? So for the diaspora, I would like to say a couple of things here. Now, we've talked about the fact that you can actually balance your cultural tax with your own personal investing and financial well-being, right? And what I would like to say in addition to that is think about how you can use your finances for development of the African continent or development of the country that you are from. Now, we understand that these remittances that we're sending back to the low and middle income economies is actually so much more significant than what we receive in foreign aid, which is a good thing. It just goes to show that actually collectively we have a lot of power to make significant change and make positive strides towards the Africa or towards the future of the globe that we want to have. And so I know there's been a challenge around, investing in places such as Africa and people taking advantage of you and not really using your resources in a way that you expected them and the way you allocated for them to be utilized. However, I would also say we are in a stage now, in a phase of the global economy where we are back to what feels like the scramble for Africa. In the Western world, a lot of development has happened. And so if you look at Africa and the opportunities that are ready for, for growth, there's significant amounts of them. Now we have companies that are listed in foreign stock markets that are already operating in Africa. And we want to be people who are taking advantage of that. So you could either choose to invest through a foreign stock market, but actually if we're thinking about developing the African continent, then we want to start investing in and with companies that are specifically on the ground in Africa, and companies that are actually ethical, that are responsible, that have good governance structures, and that are using their finances responsibly to help grow the continent, in addition to making a good return for investors. I will always say that as an investor, your number one priority is to get a good return on your investment. And next to that, you should begin to think about, how is this affecting the economy of my country? How is it affecting climate? How is it affecting the environment? And how are these companies that I'm investing in affecting the social good of society and the environments in which they operate? So I hope this has given you some really good insight into how investing is not just a one-dimensional thing. Actually, if you think about the investment landscape in totality, there's a lot of good that can happen from that. We have it within our power to make a lot of change and to drive a lot of change. And I would particularly love to see the African diaspora and the local Africans coming together to be able to invest in projects that are just good for development across the continent in general. So, public-private partnerships are always good, but equally, it's good for us as natives of the continent to be able to also benefit from economic growth, economic development, and create the future Africa that we would love to see. So thank you so much for joining me on today's episode, and I will see you next time. Bye for now.